Year to date, the market has had a mixed performance. We have some companies that have performed very strongly, up double digits, but we also have quite a significant number of companies that are down even double digits as well. Today's episode, we want to focus on Undervalued Dividend Kings, which are companies that have been paying a dividend for 50 years or more for real consistency and stability in our portfolios. But what we also want to point out is for those who don't want to look at individual stocks, there is an alternative, which is the ETF KNGS, that is the ticker symbol, and you can invest in over 30 companies, as we mentioned, Dividend King, so over 50 years of growth. Now, a few things to note with this ETF. Firstly, it is very new, so it has only been out since November of 2023. And when we take a look at the expense ratio, we can see it is 0.35%, which can be a little costly to investors over the longer term. Hence why today's episode, we are specifically looking at 4 undervalued companies for those who want to add individual stocks to their portfolio. Now, in terms of the top holdings for this ETF, if this is what you prefer, you can see the top 5 performance. You have 3M as the largest position, 4.8%. You have Black Hills Corporation, National Fuel Gas, Kimberly Clark, and Federal Realty Investment Trust at just under 4%. Now again, different investors will prefer different ways of investing, whether that's through ETFs or individual. Now the only thing we would say, given this performance is very, very new over the last few months, we can see it has really moved marginally from $25.59, and right now we can see the closing price sits at $27.68. So it's too early to say whether or not this is an ETF that has some really great performance. So let's take a look at 4 undervalued dividend kings to add to the portfolio. As always, we'll take an analysis of the historical performance. We'll look at their dividend safety, run through their financial metrics, what we like, what we should keep an eye on. And as always, we will run them through the valuation model so we get to our intrinsic value, get to our acceptable buy price given our investor margin of safety, and we'll also look towards Wall Street to see what they are forecasting for each stock over the next 12 months. So let's start off with undervalued dividend king number 1. It is PepsiCo. Now, these are essentially companies that need very little explanation. Now, we can see over the last 12 months, they are down around 6%. Over the last 10 years, however, if you have been holding, you would be up over 100%. It would, in fact, be even higher if you were reinvesting those dividends. And we can see all-time highs so nearly a year ago, May 2023, of $196. Now, it does currently trade in the mid to lower end of the 52-week range. We have 2 out of 3 buy ratings from analysts, and we can see the yield does sit around 2.91%. And the forward P is pretty much in line with the S&P 500 average of 21. So let's take a look at the dividend safety. Now we have a score of 93, very safe. In fact, one of the highest scores obtainable. Market cap, 239 billion. It is a mega cap company. Now, in terms of the last recession, while they increased the dividend during the 07-09 crash, they had above average growth, negative 0.5 versus the S&P's negative 12, and they also outperformed the S&P negative 35 with the S&P coming in at negative 55. We also did get a dividend increase just a few months ago. In fact, 7.1% in February, 7% on average over the last 5 years, and nice double digits over the last 20. So very strong performance. With PepsiCo, you always know the consistency of those dividend increases. And in fact, they are more recently a dividend king with 51 years of consecutive increases. Now, in terms of dividend yield theory, so for new viewers, it states a company is undervalued when the current yield sits above the 5-year average. We also get a sign of undervaluation with the forward P at 21.4, with the 5-year rolling at 24. Now, also understand we never look at any of these models in isolation and will conclude towards the end. We also note the consumer staples sector P does sit a little low at 19.3. Now, what we always like to focus our attention on in the payout is the free cash flow. A few reasons for this. Firstly, we do believe the earnings is susceptible to manipulation by management through accounting. One reason for this, FY22, this would be a massive red flag indicator for us. 111%. It signals that management paid out more in dividends than they generated in free cash flow. You wouldn't be able to derive this information by looking at FY22 on the earnings. The second thing to note is we like to see below 60% as a blanket rule. If you want to be industry specific, 70% for consumer staples. The reason why we like 60%, more often than not, it does give us faith that management can offer those lovely double-digit dividend increases we love to see. Now with PepsiCo, we have had issues over the longer term with their free cash flow payout being very high. Nice to note, next year it is expected to come down further to 78%, and the lower this goes, the more confidence we can have in those increases to the dividends and the general safety. Free cash flow per share, very important. What you want from companies is increasing free cash flow year on year. With PepsiCo, what we note is it hasn't increased consistently. Over the longer term, though, it has increased, although marginally. FY24 expected some very nice increase to just under $7 per share. Sales growth 3 to 7% is what we aim for steady, moderate companies like PepsiCo, and that is what we typically analyze when looking at a company's balance sheet and their income statement. What we can see over the more recent period, they have pretty much hit that, but we can see we don't get a lot of consistency over the longer term. Nonetheless, they have grown their top line, as we can see here, by just under 50% over the longer term. Now, they do return that excess cash through those share buybacks. As we can see, the shares outstanding has decreased over the longer term. But what we would say, it isn't massively consistent and it isn't a significant amount for us to really touch upon. Just nice as a little bonus that they do that. In terms of the ROIC, very consistent, which is what I love to see, and very strong year on year, pretty much 19% across the board. So that is very healthy and very attractive for investors and potential investors. And as always, we want to see a minimum of 10% just to give us faith that management are able to effectively allocate their capital. Margins, well, we get a lot of consistency with PepsiCo, as we can see, pretty much straddling the 16%. On the free cash flow, it has started to decrease. Nonetheless, even the more recent year, 9% does look strong. Finally, very important is the net debt to EBITDA, the earnings before the interest, tax, depreciation and amortization, and this affects both balance sheet strength as well as dividend safety. We want to see below 4 for consumer staples, and these numbers are the number of years it would take the company to pay off all of their debt net of cash on hand. Looking very strong, 1.91 expected in FY24. So no worries there with the dividend safety. Now, as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And generally, when we do deep dives, we do run through every single one of these models. For today's episode, let's get straight into the final intrinsic value, which in essence is just the average of these three models that you can see on screen. Current price is around $173. We always start off with a margin of safety of 10%, and we execute on this if we believe the company has a wide moat, strong financial metrics, and good forward-looking data. Now at 10%, we pretty much see it is a buy at that level, $172.35, pretty much $1 shy of the current price. So for a strong company like PepsiCo, a 10% MOS level based on the estimates and judgments. In terms of Wall Street, well, they also see this as a buy. They see around 10% upside over the next 12 months. Their price target pretty much in line with our intrinsic value. And as always, do let us know your thoughts in the comments as we go along, whether or not you're adding any of these to your watch list or in fact adding over the more recent period. Also, just to let you know, we have released our latest free weekly article. Now, in this week's article, we do run through all the resources that we use to find undervalued dividend stocks. We always get a lot of comments. What sites are we using? What resources? So if you do want to know, completely free, as well as all of these other articles, click on that pinned comment below and you will get instant access. The next undervalued dividend king we have, and we can see already 2 out of 3 buy ratings, is Johnson & Johnson. Now, it is down around 9% over the last year. However, if you've been holding over the last 10 years, you would be up 48%. Now, not the greatest return, but as always, past performance is not an indicator of future performance. It does currently trade right there towards its 52-week low. The yield is over 3% at 3.35, a fairly rare occasion for this company, and the forward PE is sitting very low at just below 14. In terms of dividend safety, well, the very safe score of 99. In fact, they have one of the best balance sheets in the world alongside Microsoft. Market cap, $356 billion. It is a mega cap company. Now, in terms of looking at those recessionary metrics, while they increased the dividend during the last recession, they had above average growth, and they also significantly outperformed the S&P with their negative 27% return. Now, in fact, we did get a dividend increase not too long ago, just a few days, 4.2%, so in line with inflation. I'll be honest, a little bit disappointing given over the last 5 and last 20 years we did see high single digit numbers. Now, they are also a dividend king, not only increasing for 61 years, but also been paying a dividend for the last 108. In terms of dividend yield theory, no surprises, a strong double undervaluation signal on the yield as well as the forward PE, and we also note it is significantly lower than healthcare sector at 17.6. In terms of looking at the payout ratios, now below 60% is something we have seen with this company. However, over the last 2 years, it did go above that. FY24 as well, we can see 55% expected, so nice to note it is coming back down to the levels we are accustomed to with Johnson & Johnson. Now, in terms of the free cash flow per share, has been increasing over the longer term, although marginally and inconsistently. Nice to note that next year is expected to be much stronger at 906. Sales growth, well, not the greatest. You do really want to see consistency, something that Johnson & Johnson is noted for, but over the longer term, they do really struggle with that. What we do note, however, is in the more recent year at 6% is still fairly strong at the upper end of the levels we look at 3 to 7%, and numerically speaking, we can see the marginal increases over the longer term. They also, similar to PepsiCo, do share buybacks, and again, similar to PepsiCo, not very consistent and a fairly trivial amount over a long time horizon. We also see very strong ROICs very consistently as well, 23% in the more recent year, looking very, very strong. Now, when we look at the margins, again, very consistent. This is what I like to see, consistency and a strong metric. We see that on both the operating side as well as the free cash flow margin side. Net debt to EBITDA, as we mentioned, they do have a very strong balance sheet, and it does show here 0.25 in FY23, 0.23 in FY24. So no worries with that dividend safety. And now with Johnson & Johnson, a fairly rare occasion getting a yield of around 3.3, 3.4%. What about the valuation of this company? Don't forget you can click on the pinned comment below to grab a copy of the intrinsic value calculator so you can essentially value companies in your own portfolio or those on your watch list. So a 10% margin of safety, we can see a buy up to 163, 15% up to 154, 20% pretty much $1 or $2 shy, so around the 15 to 20% MOS level in today's episode, although more towards the 20% level. In terms of Wall Street, well, what is their forecast? Well, they see very nice upside, 21%. Their price target is $179, so they do see this as a fairly strong buy. And as always, let us know your thoughts below. We then move on to one of Warren Buffett's favorite stocks, that is the Coca-Cola company. We have 2 buys as well as 1 strong buy rating from analysts. It does sit in the mid to upper end of the 52-week range with a yield of over 3%, 3.22, a forward PE pretty much in line with the S&P 500. However, the performance over the last 12 months hasn't been that great, down 5.5%. Over the last 10 years, however, up 45%. Again, it doesn't include those dividends reinvested. In terms of the dividend safety, we have a score of 80. It does look to be safe. Market cap 259 billion. It is a mega cap company. Now, in terms of the last recession, well, in fact, they increased the dividend. They did have above average growth, and they also outperformed the S&P with the negative 31% return. They had a nice increase, 5.4%, a little bit higher than inflation, much better than over the last 5 years, and slightly lower than over the last 20. Now, they are also a dividend king, 61 years of consecutive increases, and they have paid dividends for over the last 104 years without a reduction. Now, in terms of dividend yield theory, we do see the yield higher than the 5-year average, as well as the forward PE below the 5 years, so we do get that double undervaluation signal. But again, similar to PepsiCo, we do note the consumer staples sector PE does sit slightly lower. In terms of that essential free cash flow payout, below 70%, we can see it has in fact been slightly above that pretty much every single year, so that is a fairly consistent thing with Coca-Cola, and we do note it is expected to go slightly higher into FY24 at 86%, something just to be aware of. Free cash flow per share, well, pretty consistent. It has increased over the longer term. It is expected to be pretty much in line with FY24. So always understand the type of companies you invest in. Not all of them will be massive growth to the free cash flow. Some of them will be stable. Some of them will be inconsistent. just effectively add that into your own investment thesis and as well into your margin of safety. Sales growth, we can see very, very inconsistent, significant number of years of negative growth, although the last 3 years have been significantly better. And when you do look at it numerically from a long point, in fact, we can see it did decrease from 2014 down to 2020 before rebounding back up. We also note very, very, very minimal share buybacks across the period, so not much to note there. ROIC, well, very nice, above 12% consistently, and in fact has been increasing over the last 10 years. And when we look at the margins, nothing really to note other than operational efficiency, consistency, and very strong numbers across the board. Last year's free cash flow margin at 21% was very healthy as well. Net debt to EBITDA, no worries whatsoever with the balance sheet. In fact, been decreasing from the highs of that pandemic 2020 3.03 level down to 1.99 expected in FY24. So that is very healthy, very reassuring for investors and dividend growth investors too. In terms of the valuation of this company, well, in today's episode, it is coming to $67.34. With a current price of $60, we use that margin of safety of 10%, and we can see you are getting just over a 10% MOS level for the Coca-Cola company in today's episode. How about the forecast of Wall Street? Well, $67, upside of around 12%. Again, they do indicate this is a buy, and as we saw earlier, 2 buys ratings with analysts and 1 strong buy rating. We then move on to the 4th undervalued dividend king company, Kimberly Corporation. Now, we do note it has 3 hold ratings from analysts. It is trading right now towards the mid to lower end of the 52-week range. It has the highest yield today of 3.85%. Forward PE significantly lower than the S&P at 18.4, and we can see over the last year, not the greatest performance, down 8%. Over the last 10 years, up 20%, but very, very roller coastery, as we can see, up and down significantly over the more recent year. All-time highs does sit around $158 around 4 years ago today. In terms of dividend safety, well, we have a very safe score, 88, market cap 43 billion, a large cap company. Last recession, well, they did in fact increase the dividend. They had above average growth, and they also outperformed the S&P with their negative 34% return. But one thing we do say with this company, they really marginally increase those dividends by around the inflation level. You have to go back over 20 years to see a 6% year-on-year increase. They are a new recent dividend king, and they have been paying dividends for the last 89 years without a reduction. In terms of dividend yield theory then, we get that double undervaluation signal, the yield of 3.85% and a forward P of 18.4, and we can see it is marginally lower than consumer staples of 19.3. In terms of this company's free cash flow payout, whilst it is a bit inconsistent as we can see over the longer term, nice to note FY23, the more recent year, at 57%, and FY24, though, it is expected to be slightly higher than the 70% level at 74%. When we look at the free cash flow, we do see growth over the longer term, nearly double in fact, but we also see the peaks and troughs where it does come down and does have some years of staying stable. FY24, though, we can see a reduction is expected. In terms of sales growth, well, you're not really going to get more than 3 to 7%. In fact, we do note 4% has been the highest over the more recent period. So again, do factor that in, but do understand the type of companies that these companies that we are analysing today are. Total sales then barely moved over the longer term. So again, understand this isn't a tech company. Shares outstanding, they have been doing those share buybacks, but similar to these dividend kings, it isn't a massive priority for them as they do pay out dividends, which is a significant amount of their free cash flows. In terms of the ROIC, even though it has been decreasing over the last 10 years, 29% is still very, very strong, especially when 12% plus is the minimum aim for consumer staples as a whole. Margins also straddling around the 16%, free cash flow margins looking a lot better, 14%, one of their best years over the last 10 years as well, very healthy for the free cash flow. Net debt to EBITDA, one of the best balance sheets that we have reviewed today, 1.83 in FY23, 1.75 in FY24, so the dividend is going nowhere, and you are getting roughly an inflationary increase year on year. As we said, this yield is now nearly touching the 4% level. In terms of the valuation, let's get to it in today's episode, and we can see the average of these 3 models coming to $148. Now, in terms of the current price at $127, a 10% MOS level would be a buy up to 134. At 15%, we can see pretty much under $1 difference. So we have a 15% MOS level for KMB Kimberly Clark in today's episode. How about Wall Street and their forecast? Well, they see upside of 10%. They have a price forecast, in fact, of $140, lower than our intrinsic value, and that is what they see. We did mention earlier, this is the first one out of those that we have reviewed where 3 analysts do give it a hold rating. As always, though, do let us know your thoughts in the comments below. Are any of these stocks ones that you have been adding over the longer term? Is it some that's on your watch list? Or for whatever reason, maybe you do prefer investing in the ETF that we did discuss earlier on. As always, let us know your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.